Welcome to this explainer. Today we're going to unlock one of the most misunderstood yet absolutely critical elements of mastering prop firm evaluations and securing your funding. If you're a trader aiming to get funded, or even if you're just dipping your toes into the prop firm world, you already know that making a profit is the name of the game. But as we're going to explore, how you make that profit actually matters just as much as the profit itself. I am super excited to guide you through this material today, so let's jump right in and set you up for success. Picture this incredibly painful paradox. You've been trading for a few days and suddenly you catch a massive move in the market. Boom! You make a huge profit in a single day. You're celebrating thinking you've just crushed your evaluation. But then you check your dashboard or get that email and you didn't pass. In fact, you actually failed the challenge. Wait, how is that even possible? How can making a ton of money be a bad thing? Well, this is the exact trap that catches thousands of traders completely off guard every single day, and it all boils down to how prop firms view risk.
Here is our roadmap for today. We'll cover the big profit trap, the consistency rule, the formula and calculation, a practical 5-day example, improving your consistency, and finally, mistakes to avoid.
Let's start with Section 1, the big profit trap.
This concept completely flips the standard retail trader mindset upside down. When you're trading your own personal, smaller account, a massive one-day gain is a huge reason to celebrate, right? But prop firms, they operate on an entirely different level. They're looking to fund traders with real, substantial capital. So if you earn your entire profit target in one single day, or just over a couple of wild trades, it immediately raises a massive red flag. To the firm, this doesn't look like skill. It looks like you over-leveraged, gambled, and just happened to get lucky. They need hard proof that your edge works consistently over time, not just on one crazy setup. Because look, if you can make it all in one day, you can definitely lose it all in one day too.
Moving right along to Section 2, the consistency rule.
So what is this rule exactly? The consistency rule is a strict requirement enforced by tons of prop firms, especially during the evaluation phase, that limits how much of your total profit can come from your single best trading day. Now, the exact limit varies depending on where you go, but it usually sits somewhere in the 25 to 50% range. For instance, firms like My Funded Futures enforce a 50% daily profit limit during evaluations. And I want to be super clear about this. This rule is not a trap designed to make you fail. It's actually a benchmark of true professionalism. It proves that you can manage risk, navigate shifting markets, and grind out steady, reliable performance. If you're dealing with a standard 50% consistency rule, just imagine your total profits as a pie. No single slice, meaning no single trading day, can take up more than half of that entire pie. So if your profit target is, let's say, $5,000, and the rule is 50%, your best single day literally cannot contribute more than $2,500 to that total. If it does, your pie is totally out of balance. Now, you wouldn't necessarily blow your account, but you wouldn't pass the evaluation just yet either. You'd be required to keep trading and generate smaller, consistent profits just to dilute that one big, massive day until your pie looks balanced again.
All right, Section 3, the formula and calculation.
If you're going to remember just one thing from this explainer, make it this golden equation right here. Best day profit divided by total profit multiplied by 100 equals your consistency percentage. It's incredibly simple, but you absolutely have to know it by heart. Let's say your total profit across your valuation is $10,000, and your absolute best day was $4,000. You divide 4,000 by 10,000, which gives you 0.4. Multiply that by 100, and boom, you get 40%. If your firm has a 50% rule, you are perfectly compliant. Nicely done. But if they run a stricter 30% rule, you're over the limit, and you're going to need to keep trading to bump up that denominator, your total profit, until your percentage drops safely below 30.
Section 4. Let's look at a practical 5-day example.
Let's walk through a very realistic trading week. On Monday, day 1, you make a solid $500. Day 2, a great $700. Day 3, a bit slower at $400. And day 4, you bounce right back with $600. Up to this point, this is a beautiful, consistent equity curve. You're proving your edge. But then comes day 5. Maybe there was a massive news drop, or maybe you just held a runner way longer than usual, and you bank a massive $1,800 profit. In the moment, it feels amazing. But let's look at the actual math. If we add all these days up, your total profit for the week comes out to $4,000. Now we apply our formula. We take that best day profit of $1,800, divide it by the total profit of $4,000, and multiply by 100. That equals 45%. Under a standard 50% rule, you are technically still passing, but man, you are dangerously close to the limit. If that day 5 profit had been just a couple $100s higher, you would have breached the 50% mark. This heavy concentration of profit is exactly what prop firms are monitoring. When you see your consistency creeping up to 45%, you need to realize that your next steps are all about risk management, not trying to hit another home run.
Moving into Section 5, improving your consistency.
So prop firms know that we're humans trading fluid markets, right? We aren't robots that can print the exact same dollar amount every single day. Because of this, some firms offer what is called a leniency buffer. For example, my funded futures offer specific buffers depending on your account size. If you're trading a $50K account, there's a $100 leniency buffer. A $100K account gets a $200 leniency, and a $150K account gets a $300 buffer. What this means in practice is that if your daily profits are just slightly off, say you pull in $1,450 on Monday and $1,550 on Tuesday on a $50K plan, they aren't going to penalize you for that minor variance. You're still considered totally consistent. It's a fantastic feature, but just remember, not all firms offer this, so you always want to check your specific firm's conditions.
And to make sure you never accidentally breach these limits, you absolutely don't have to sit there with a spreadsheet doing manual math every afternoon. There are fantastic free tools out there like the Prop Firm Consistency Calculator. Using it is basically a four-step process. First, select your prop firm plan, like Core, Scale, or Pro. Second, choose your account size, whether that's 50K, 100K, or 150K. Third, input your daily P&L. And fourth, just keep adding a row for each day you trade. The calculator automatically tells you if you're compliant and exactly how much daily profit you should aim for to pass. It is a total game changer for maintaining your discipline without the mental fatigue of doing constant math.
Finally, Section 6, mistakes to avoid.
These frequent errors basically form a graveyard of failed prop firm evaluations. Let's make sure you don't end up there. The first major mistake is risking way too much of your account on a single trade. If you do this and win, you instantly violate the consistency rule. If you lose, you hit your daily loss limit. It's literally a lose-lose. Second, rushing to hit profit targets. Remember, trading is a marathon, not a sprint. Third is the classic beginner trap, doubling your position size after a winning streak. This violently skews your profit distribution. Fourth is simply ignoring your specific firm's rules. Assuming every firm is the same is just a recipe for disaster. And finally, confusing profitability with consistency. As we've seen today, you can be wildly profitable, yet entirely inconsistent. Prop firms demand that you are both.
A quick heads up before we wrap up. This explainer is strictly for educational purposes and isn't financial advice. The specific rules, percentages, and leniency buffers we looked at today can and do change depending on the prop firm and current market conditions. You must always verify the official, up-to-date conditions of your specific firm before you ever place a trade.
I really want to leave you with this final thought. In the prop firm industry, simply making money isn't enough anymore. You have to master how that money is made. It's the combination of profit, strict risk management, and steady consistency that creates true trading discipline. If you're serious about developing this level of professional edge and you want to master these methodologies, you should definitely consider subscribing to KRIT Academy for more in-depth training. Mastering the consistency rule isn't just about passing some arbitrary test. It's about transforming yourself into a trader who actually deserves to be funded. Thanks so much for joining me for this explainer. The markets are always going to offer you a chance to get lucky. But are you ready to stop gambling and start managing risk like a true funded professional?